This report here is from the Oklahoma Department of Agriculture at the Oklahoma City, Oklahoma Stockyards. This is their feeder calf sale that was on Monday, October the 27th. Today is October the 29th. We look at these every week because traditionally cattle markets don't move in big swings. However, there are exceptions to everything. And as you know, this cattle market right now has a lot of volatility in it. It has made some major moves. But from week to week here, we have to make marketing decisions in real time. We know it's making major moves because it's 30 to 40 lower. It's 40 to 50 lower. So that market is declining and declining pretty fast from its all-time highs where it has been. But that volatility creates opportunity as well. So let's just jump in and take a look. So we want to look at these steers, medium and large number ones. That's kind of where we want to camp out today. We're not going to spend a lot of time right here, but this is a spot that kind of caught my eye. So these 413 pounders and these 415 pounders right here below it. So 413, 415. Look at the price spread between those two. The 473.89 and $520.39. So you do the math on that. You take those out per head, and you end up here with $183 difference between those two. There is roughly, they are really apples to apples as far as size and quality of those cattle go. So the only difference is this one here was flagged as unweaned. So, it's up to you where your risk tolerance is, if it's worth making a swap right there. But you do got to account for a loss of productivity and that risk of bringing that unweaned calf in right now, especially this time of year with these temperature swings. Here it's wet, it's cold, it's muddy. Anyways, I just wanted to point that out, that just an unweaned calf versus a weaned calf right here, there is $183 difference in those. The right person, the right setup, the right scenario, that may be worth an opportunity there for you. But again, you got to take into account that the risk that's associated with that. But what I really wanted to key in on here, this is what I want to look at. So look at these 827 pounders, and we're going to compare these to these 682 pounders right here. So these are both not flagged. So these are quality cattle. They're not flagged as being unweaned, balling. They're not bulls or steers. So basically apples to apples comparison between these two. Now what caught my eye is a 827 pounder brought 333.43. A 682 pounder brought 332.44. That is very, very close. There is 145 pounds difference between these two classes. And anytime you can sell one and you can buy one back for roughly the same money here, chances are it's going to be profitable. So let's jump over and dump that into our handy dandy calculator, which I took the liberty of dropping that in there. So that's 827 pounder right here at 333.43. And we really want to compare that to this one here, this 682 pounder at 332.44. I've got a mistake in there. It's 332.44. Let's fix that real quick. 332.44. That will change everything, and it did. So 332.44. So what we are looking at, what we want to key on here is the weight difference right there, that 145 pounders. There is $490.23 in value. So if I sold this 827 pounder, I replaced it with 682 pounder. I sold one, I bought one, I own the same number ahead, but I got $490.23 potential in my pocket. We do have to account for a couple of things. So that cost of gain. The cost of gain needs to be applied onto that one that we sold. I've used 75 cents on here. That could be low, it could be high. I don't know. You could argue that with me, but you just got to know what your cost of gain is, and you know for sure that if your return on gain is greater than your cost of gain, that you are going to be profitable. Your cost of gain here on a per pound basis is $1.0875 versus that return on gain $3.38. So you kind of know this before you even got into it. Whenever you can sell one and buy one back for the same money, price per pound, price per hundredweight, which we're darn close right there, right? Whenever you see that, you know it's going to be a profitable trade. So in this scenario right here, if your return on gain was 338, your cost of gain was 108.75, you profit or loss, this is taking out your cost. So your cost of what it cost to put that 145 pounds on, you are still able to capture $381.48. So that is an ROI of 16.83. And you're not going back very far here. A lot of times to get that kind of a return, that $381, you've got to go back all the way, to this 400 pound to where you're putting 300 pounds or better spread between what you sold and what you bought back. But here it's only 145 pounds. So where that benefits you is you're going to bring them right back up here pretty quick. And then you got the opportunity again. So what you want to do, if you made this trade, you want to watch it, from the day you buy them and get them straightened back out, you want to watch and look for an opportunity where you could trade that 682 pounder and trade backwards of the same quality. That's important. If I sold a medium and large number 1, which we have priced here, and I bought back, say, a Holstein, I'd have a huge profit or loss here. But the is you only get to do that one time because now you own Holsteins or whatever, and there's nothing wrong with that. People trade those Holsteins just the same. But just know that if you go backwards in quality, it's really hard to claw your way back up. So just make sure whatever you're selling and buying are of the same type quality of cattle. So anyways, just wanted to point that out. That's just kind of a interesting fact that I found today, is that $381.48 in my pocket on this trade for 145 pounds. And it's easier to make cash flow when you're measuring cash flow and you're trading cattle, not trading them like sale barn A to B, but bringing them home, cleaning them up, holding them, getting them healthy, and then swapping them for an undervalued class. It's easier to do that in a falling market than it is in a climbing market. And the reason for that is pretty simple, really, is you want to replace them with a animal that is worth less than the animal that you just sold. And if that market's falling, that just puts a bigger spread between what you bought and what you sold. Gives you a chance there. So anyways, I hope this was at least entertaining, if nothing else. Let me know down in the comments what you think, and we will catch you on the next time. So we'll see you then. Bye-bye.